During the height of the US-China trade war, something happened that most people never noticed. Tariffs were rising, rhetoric was escalating, political tensions were dominating headlines. And yet, behind the scenes, some of the largest financial institutions in the United States were doing the opposite of what the politics suggested. BlackRock, JPMorgan, Goldman Sachs. Together, they expanded exposure to China by more than $1.4 trillion during the very period when Washington was publicly trying to economically decouple. This wasn't a secret deal, it wasn't illegal, and it wasn't ideological, it was structural. Today we're going to explain why this happened, why it had nothing to do with Trump personally, and why this move fits a recurring historical pattern that appears in every late-stage monetary system. This is not a prediction. This is pattern recognition. Why politics didn't matter to capital. The biggest mistake people make when looking at this story is assuming it was political. It wasn't. Capital does not respond to speeches, tariffs, or headlines. It responds to constraints inside the monetary system. During the Trump trade war, political messaging suggested decoupling, but the financial system was sending a very different signal, and large institutions listened to the system, not the rhetoric. By the time tariffs were imposed, the U.S. economy was no longer operating in a normal growth cycle. It was operating in a liquidity-dependent system. Key characteristics were already in place: persistent fiscal deficits, rising federal debt with no political path to reversal, asset prices increasingly supported by monetary policy, real interest rates near or below zero. This matters because in such systems, capital behavior changes. Investors stop asking, "Where is growth strongest?" and start asking, "Where can large amounts of capital exist without destabilizing the system?" That shift is subtle, but decisive. Trade wars affect margins and supply chains. Monetary conditions affect survival. While the U.S. was escalating tariffs, it was also expanding deficits to offset economic drag, supporting asset prices, implicitly signaling long-term accommodation through the Federal Reserve. That combination told large institutions something very specific. The U.S. system would rely on liquidity support indefinitely. In late-stage monetary systems, that creates a predictable outcome. Capital seeks external balance sheets to hedge internal fragility. This has nothing to do with loyalty. It has everything to do with preservation. Retail investors react to events. Institutions react to structure. Firms like BlackRock, JPMorgan, and Goldman Sachs manage capital at a scale where domestic concentration becomes a risk. When a single system becomes too large, too leveraged, and too policy-dependent, diversification is no longer optional. It becomes mandatory. That's what happened during the trade war. China, as a capital sink, not a political statement. The second major misunderstanding is why China was the destination. This wasn't about optimism on China, it was about capacity. At scale, capital does not prioritize democracy, transparency, free markets. It prioritizes absorption capacity, stability under stress, predictable intervention. China offered something rare in the late 2010s, a financial system large enough to absorb trillions without immediate repricing. That is incredibly valuable in a world drowning in liquidity. China functioned as a capital sink because it combined massive domestic savings, state-controlled banking channels, gradual, selective opening to foreign institutions, implicit government backstops. This created an environment where large flows could enter without triggering volatility. In late-stage monetary systems, volatility is the enemy. China reduced it. Tariffs don't affect capital plumbing. Financial flows move through, custody clearing, balance sheets, regulatory carve-outs. While trade was being restricted, China was opening bond markets, granting licenses to foreign asset managers, allowing greater foreign ownership in financial firms. This wasn't coincidence. It was alignment of incentives. China needed external capital to stabilize its system, Wall Street needed external capacity to stabilize returns. The trade war sat above this reality, not inside it. To the public, this looked like hypocrisy. To capital managers, it looked like risk management. When one system enters late-stage monetary dynamics, capital naturally seeks counterweights. That doesn't mean China was stronger. It means China was different enough to matter. The four-stage monetary pattern. Wall Street recognized. What happened during the trade war only makes sense if you zoom out, far out, because capital doesn't react to individual presidents or policies. It reacts to where a monetary system sits in its life cycle. And history shows that every dominant currency system follows the same four-stage pattern. Not because of ideology, not because of mistakes, but because of mathematics. Every system begins with constraints. Money is scarce, debt is limited, capital formation is productive. Growth comes from investment productivity, expansion of real output. In this stage, capital stays home. There's no need to look elsewhere. As confidence grows, constraints loosen, debt expands, money becomes easier, capital globalizes. This phase feels like success. Living standards rise, asset prices climb, global integration accelerates. Most people believe this phase is permanent. It never is. This is the critical phase. And this is where the U.S. system was during the trade war. Growth becomes dependent on asset prices, debt expansion, monetary intervention. Returns come less from production and more from financial engineering. At this stage, debt is no longer cyclical. Its structural policy prioritizes stability over correction. Liquidity becomes the primary tool. This is when capital behavior changes fundamentally. Capital stops chasing growth. It starts chasing balance sheet protection. Large institutions look for external diversification systems with different risk profiles, places where liquidity can hide without causing repricing. This is not fear, it's preparation, and it happens before crisis, not after. Stage 3 systems generate too much capital relative to domestic capacity. Returns compress, volatility rises, policy becomes reactive, capital must move, or accept declining real returns. This is the moment Wall Street recognized, not because of Trump, but because the U.S. system had entered a familiar historical phase. Why Wall Street's move was mechanical, not strategic. Once you understand the pattern, the $1.4 trillion shift stops looking dramatic. It starts looking inevitable. No boardroom decided, let's move money to China. Instead, risk models adjusted, return assumptions shifted, regulatory pathways, open portfolio allocations changed incrementally. Each move made sense on its own. Together, they formed a massive flow. That's how structural reallocations always happen. China didn't need to be better. It only needed to be different. It offered capital controls that dampened volatility, state-backed financial markets, high domestic savings, a managed opening to foreign capital. For large institutions, this provided something scarce in late-stage systems: predictability under stress. The trade war increased uncertainty. Uncertainty raises the value of diversification. While political risk rose, monetary risk mattered more. And China's system, despite its flaws, offered a counterweight to Western liquidity dependence. This wasn't defiance, it was hedging. To the public, this looked contradictory. To capital, it was textbook behavior. When one system becomes over-leveraged, policy tools become exhausted. Returns compress, capital looks for external balance sheets, not to escape collapse, but to survive transition. Why this move was misunderstood by the public. To most people, the $1.4 trillion shift looked contradictory. On the surface, it seemed like Wall Street was undermining national policy, like institutions were ignoring geopolitical reality, or worse, betting against their own country. That interpretation misses the point, because this wasn't a political decision. it was a systemic response. Public narratives focus on intent. Markets respond to structure. Governments speak in terms of strategy, ideology. National interest capital operates on balance sheets, liquidity conditions, risk concentration. When those two worlds diverge, misunderstanding is inevitable. This exact pattern has repeated throughout history. When a dominant monetary system enters a late stage, capital begins diversifying externally. Public trust assumes loyalty should override incentives. Institutions are accused of disloyalty, but capital does not defect. It reallocates. And it does so before crisis becomes obvious. That's why these moves always look wrong, until history catches up. By the time capital movement is widely understood, the flow is already complete. Opportunities are gone. The narrative has flipped. What once looked suspicious is later described as obvious in hindsight. That delay is not accidental, it's structural. When a monetary system reaches a point where it can no longer absorb liquidity internally, generate real returns without leverage, maintain fiscal credibility, capital seeks external balance sheets. This is not collapse, it's transition. And transitions are where the largest reallocations occur. The $1.4 trillion shift wasn't an endpoint, it was an early signal. History shows that once capital begins this behavior, diversification accelerates, political alignment matters less. Monetary stability becomes the dominant concern. These processes unfold over years, not months, and they rarely reverse. Trade wars are episodic. Monetary cycles are structural. One can be reversed with legislation, the other can't. The forces that pushed capital outward during the trade war, debt saturation, liquidity dependence, policy exhaustion, have not been resolved, which means the incentives remain. The $1.4 trillion shift to China was not a vote of confidence in China. It was a warning about the United States, a signal that the system had entered a phase where politics and capital no longer move together. Liquidity matters more than ideology. And institutions quietly prepare for outcomes governments cannot publicly acknowledge. This wasn't about Trump. It wasn't about tariffs. And it wasn't about China winning. It was about where the global monetary system sits in its cycle. History shows that when capital starts behaving this way, it's not the beginning of instability. It's the middle. And the middle is where most people are still arguing about motives, while the structure has already shifted beneath them.